What if I told you the world is quietly moving its money, not into stocks, not into crypto, but into something far older, far quieter, and right now, far more powerful? While headlines scream about inflation and bank wobbles, a silent financial storm has been brewing. And its lightning strike, an all-time high in gold and silver rocketing right alongside it. This isn't just a market blip. This is a safe haven stampede. Welcome to Bullion Signal, where we decode the language of the markets. Stick with me, because in the next 30 minutes, we're going to pull back the curtain on exactly why this is happening right now, what it says about the global economy, and crucially, what it could mean for your money. And if you're new here, do us a favor, hit that like button and subscribe to Bullion Signal. It's your free signal in a noisy market, and it helps more people find this crucial information. Now, let's set the scene. For decades, we've been told a story that modern finance, with its digital transactions and complex derivatives, had made the old relics, gold and silver, obsolete. They were for doomsday preppers or jewelry lovers, not serious investors. But the market itself is now telling a very different story, one written in stark, rising price lines on a chart. Breaking all-time highs is a monumental psychological event. It's the market shouting that all the old rules, all the previous ceilings, have been shattered by a new overwhelming force. And that force is a profound global loss of confidence. It's fear, but it's a smart fear. A calculated move to protect wealth when the traditional pillars of the financial world seem to be cracking. At Bullion Signal, we've been tracking the whispers before they became this roar. And those whispers point to a perfect storm of factors converging at this very moment. The most immediate and visceral factor is the loss of trust in the value of paper money itself, inflation. You feel it at the grocery store, at the gas pump. Your dollar simply buys less. For years, central banks, including our own Federal Reserve, told us inflation was transitory. But when prices stick and keep climbing, people and giant institutions start looking for a lifeboat. Gold and silver have been, for thousands of years, the ultimate store of value. You can't print more of them with a click of a button. Their supply is limited by what we can pull from the earth. So when the printing presses have been running hot, as they have for years, and the purchasing power of currency erodes, the timeless logic kicks in, move towards the asset that can't be inflated away. It's not that gold is magically worth more. It's that it takes more devalued dollars to buy the same finite ounce. This is Finance 101, but we're seeing it play out on a global scale right now. But it's deeper than just inflation. It's about interest rates. For a long time, gold had a hurdle. It doesn't pay interest or dividends. When you could park cash in a savings account or a government bond and get a decent, safe return, the appeal of a barbarous relic was less. But the game has changed. Even with rate hikes, when you factor in inflation, what are you really earning? Often you're still losing purchasing power in real terms. That's called a negative real interest rate. And in that environment, the opportunity cost of holding gold vanishes. Why earn a pretend yield that deaths eaten by inflation when you can hold an asset with a millennia-long track record of preserving wealth? Furthermore, the rapid rate hikes themselves are causing stress, the kind of stress that makes gold shine. We're talking about the fear of something breaking, which leads us to the next powerful driver, systemic anxiety. The banking scares we've seen, the regional bank crises, they weren't just news stories, they were wake-up calls. They reminded everyone, from the pension fund manager to the individual saver, that banks are not vaults. They are institutions that lend out your money. And in a high-rate environment where some of their older loans and bond holdings lose value, they can get into trouble. This sparks a primal instinct. Maybe I want to hold something physical, outside the banking system altogether. Gold and silver, especially in physical form like coins or bars, are exactly that. Financial insurance held in your own hand. They are the antidote to counterparty risk. When trust in the system frays, the demand for this kind of tangible, no-promises-needed asset explodes. And here at Bullion Signal, we watch these fear indicators as closely as the price charts themselves. Now, let's zoom out from the US for a moment. Because this rally isn't an American story, it's a global one. And one of the biggest players on the global stage has been quietly, consistently buying gold like there's no tomorrow. Central banks themselves. Nations like China, India, Poland, and Singapore have been net buyers for over a year straight. Why would a central bank buy gold? For de-dollarization and geopolitical hedging. They are looking at the world, seeing sanctions used as a financial weapon, seeing trillion-dollar debts, and deciding they want to diversify their reserves away from just US dollars and treasuries. They want an asset that no other country can freeze, sanction, or inflate. That asset is gold. When the world's most powerful financial institutions are in a buying frenzy, they create a massive, sustained floor of demand under the price. They are not day traders, they are long-term strategic accumulators. This isn't speculation, it's a fundamental shift in how nations think about safety. And then there's silver. Often called gold's wild cousin, silver is putting on a spectacular show of its own. It plays a double, even triple role. First, it's a precious metal, a little brother to gold that rides the same safe haven waves. But second, and crucially for our future, it's an irreplaceable industrial metal. We are in the dawn of the green energy revolution. Every solar panel, every electric vehicle, every piece of new electronic infrastructure requires silver. Its conductive properties are unmatched. So, while investors are buying silver as a monetary metal, industries are consuming it at a record pace for solar farms and AI data centers. This creates a potent supply-demand squeeze. The available above-ground stockpiles are shrinking. So silver isn't just benefiting from fear, it's being propelled by a vision of a high-tech green future. It is a bridge between the old world of safe havens and the new world of technological necessity. So we have inflation eroding currency, interest rate chaos, banking jitters, relentless central bank buying, and an industrial revolution in silver. That's the perfect storm. But what does it mean for you watching this? First, understanding the why is more important than chasing the price. This move is a signal, a giant flashing warning light on the dashboard of the global economy. It's telling you that smart money is preparing for volatility, for uncertainty, and for a potential reevaluation of what real wealth is. For decades, the focus has been on growth at all costs. Now, the focus is shifting decisively towards preservation. At Bullion Signal, we believe knowledge is the first form of wealth preservation. Understanding these dynamics allows you to have conversations, make informed decisions, and see through the daily market noise to the larger tectonic plates shifting beneath our feet. Now, a critical question many of you might be asking as we head into the final part of our discussion. Is it too late? The prices are at all-time highs after all. History offers some perspective. When an asset breaks into truly new territory, it's often because the old paradigms that capped it are broken. There's no longer a ceiling of overhead sellers from previous peaks because everyone who bought at those old peaks is now in profit. This can sometimes clear the way for a move that redefines what's considered normal. The key drivers we discussed: de-dollarization, green energy demand, negative real rates. They aren't overnight stories. They are multi-year, even multi-decade trends that are just gaining mainstream recognition. This doesn't mean prices go straight up without pullbacks. They never do. Volatility is part of the deal. But it does suggest the fundamental case for owning a slice of this physical, finite insurance is stronger now than it has been in generations. As we wrap up this deep dive, remember this: markets are discounting mechanisms. They price in the future today. These record prices in gold and silver are a massive collective bet on a future that looks very different from the stable, low-inflation world we took for granted for so long. They are a bet on continued uncertainty, on geopolitical reshuffling, and on the enduring truth that, in times of crisis, humanity has always returned to the tangible, the rare, and the universally accepted. This isn't about doom, it's about prudence. It's about listening to what the markets are screaming and understanding the story behind the numbers. So, if this rally is built on such solid, fear-driven foundations, what happens when the fear subsides? Does the whole thing come crashing down? Or is there something more permanent, more seismic shifting beneath our feet that most people are still missing? Welcome back to Bullion Signal. If you're just joining us, you'll want to check out part 1 first, because we're about to dive even deeper into the machinery of this historic move. Stick around, because what we're uncovering isn't just about metals, it's about a fundamental rewrite of the rules of wealth. And for those of you who've been with us from the start, thank you. If this channel is providing you value, that like button and subscription to Bullion Signal is the best way you can support this work and keep these signals coming. Now let's tackle that big question head on. Is this all just fear? And if so, is it temporary? To answer that, we need to look at who's buying. We already talked about central banks. Their buying isn't based on a fleeting emotion. It's a cold, calculated, multi-year strategic shift. They aren't day trading gold. They are repatriating it, moving it from vaults in New York and London back to their own soil. This is a move measured in decades, not news cycles. So that layer of demand isn't going to vanish if inflation ticks down 1 month. It provides a permanent rising floor. Then look at the big money, the pension funds, the family offices, the sovereign wealth funds. For years, holding zero gold was a standard portfolio model. Now, allocating 2%, 5%, even 10% to physical gold is no longer seen as radical. It's seen as prudent risk management. This isn't hot money rushing in and out. This is slow, institutional rebalancing that creates a constant underlying bid in the market. At Bullion Signal, we see this in the flow data. The buyers aren't just the fearful, they are the strategic. This leads us to a critical psychological point: the normalization of higher prices. When an asset lingers below its old high for years, that high becomes a mental barrier, a ceiling. But once it decisively breaks through and holds, something fascinating happens. That old ceiling becomes the new floor. The market's entire perception of value is reset. What once seemed expensive now becomes the baseline. We are witnessing this reset in real time. Each pullback is being bought, not sold in a panic. This is the behavior of a market that has internalized a new, higher valuation paradigm. It's no longer a question of if gold is worth $2,000 an ounce. The market has answered with a resounding yes. The question now becomes, within this new paradigm, where does it go next? And the drivers for the next leg might surprise you. Let's talk about the debt. The sheer, staggering, incomprehensible mountain of global debt. This isn't a political point, it's a mathematical one. The US national debt alone is measured in tens of trillions. The cost to service that debt, just pay the interest, is becoming one of the largest line items in the federal budget. Now, how does this connect to gold? Historically, there are only a few ways out of a debt burden this large. Grow your way out, which seems challenging. Default, unthinkable for a major reserve currency, or inflate your way out. Inflation erodes the real value of debt over time. It's the least painful option politically, but it's devastating for the purchasing power of currency. Gold is the classic hedge against this exact scenario, the currency debasement play. So the debt story isn't a short-term headline. It's a slow-burning fuse that directly supports the long-term case for hard assets. When you own gold, you're essentially opting out of that debasement equation. Now, let's address the elephant in the room for many modern investors. What about Bitcoin? Isn't it digital gold? This is a vital discussion. Bitcoin has certainly carved out a role as a high-risk, high-reward speculative asset and a hedge against traditional finance. But the recent parallel rally tells a nuanced story. They aren't canceling each other out. They are, in many ways, rising together. Why? Because they are both, ultimately, answers to the same question. What do I own when I don't trust the traditional system? They are different answers for different investors. Gold is the low volatility, established physical answer. Bitcoin is the high volatility, digital, algorithmic answer. Their simultaneous strength isn't a contradiction. It's a confirmation that the distrust is broad and deep. It's not an either-or for the market. For many, it is about having a foot in both camps, the ancient and the modern, to hedge against different types of systemic risk. At Bullion Signal, we watch this relationship closely, as it tells us about the maturity and breadth of the safe haven trade. So, with all this in mind, what's the practical path forward? First, dispel the myth of timing the perfect entry. Trying to catch the exact bottom in a market like this is a fool's errand. The strategic approach is about allocation, not speculation. It's about asking, does it make sense for my portfolio to have a portion of my wealth in an asset that acts as insurance? And just like you don't buy fire insurance after you smell smoke, the time to establish an allocation is before the next crisis headline hits. Second, think about the form. Physical metal, coins, bars, held directly, is for true outside-the-system insurance. ETFs and mining stocks are more convenient, but come with counterparty and market risks. They are correlated but not the same. Your approach should match your goal: permanent insurance or tactical trade. As we near the end of this comprehensive look, remember this. Markets are stories. For over a decade, the dominant story was, there is no alternative to stocks. That story is cracking. A new, older story is reasserting itself. It's the story of tangible value, of scarcity, of sovereignty over your own wealth. Gold and silver breaking records is the market's way of screaming that new story from the rooftops. Ignoring it because the assets seem old-fashioned is to ignore the message because you don't like the messenger. The smart move is to understand the message. You've invested your valuable time to understand this complex shift, and for that, I thank you. If this deep dive has given you a clearer picture, pay it forward. Share this video with one person who needs to hear this story. A family member, a friend concerned about their savings. Let's get this crucial conversation moving beyond echo chambers. And of course, your voice is part of this. I read every single comment. So tell me below, after hearing all this, what's your biggest takeaway? Are you rethinking your own allocation, or do you see a different narrative playing out? The discussion is where the real learning happens. Thank you for being part of the Bullion Signal community. Until next time, stay prudent, stay informed, and always look for the signal in the noise.